What's up, guys? Eric here, Mr. Fired Up Wealth, bringing you volume number 10 in the Masterclass series. Now, today we're going to do technical analysis, volume 2, and I'm so fired up that my glasses are fogging up again, so I'm just going to take them off. So the last time we did a technical analysis video, it was much more for the introductory, for the long-term investor. You think of trend lines, you think of RSIs, you think of moving averages, and I think that that's a really good foundation for a long-term investor to use technical analysis to get better entry and exit points. Now, today we're gonna go a little deeper. We're gonna go into candlesticks. We're gonna show you some different types of candlesticks. We're gonna go into chart patterns so you can start recognizing patterns on charts. And that really can help you be a better long-term investor. More importantly, if you want to trade, if you want to be a swing trader or a day trader, and I always recommend if you're gonna trade, have a long-term portfolio, a separate smaller account that you trade in. There's nothing wrong with that. And you can use technical analysis, like we're gonna cover today, to really trade, to get some good entry and exit points, understand when a chart might turn where you could maybe make a little bit of money, and maybe when you might wanna sell and get out because the chart's gonna turn and go the other direction. So there are some very strong signals that you can use, especially if you understand candlesticks in combination with chart patterns. And that's exactly what we're gonna cover today. So without further ado, let's get started. All right, guys, masterclass number 10. Let's get right into this stock market investing. If you haven't watched the first 9 videos, go back and watch those. This is technical analysis part 2. We're going to cover candles and patterns. This is going to be a really good video. So what is technical analysis? You should know by now, but it is used to evaluate investments and identify trading opportunities by analyzing statistical trends such as price movement and volume. I said movement weird. Price movement and volume. Japanese candlesticks. So Japanese candlesticks, this is really important, so please stay tuned and pay attention to this. This is really good. I think that you'll actually, even if you don't believe in technical analysis, you're going to watch this video and be like, wow, this is really cool stuff. So Japanese candlesticks, they're chart units that display price movement, okay? They represent a specific time frame and provide data about the price's open, high, low, and close during the period. Now, candlesticks represent a specific time frame, and it can really be anything. It can be a minute, 5 minutes, 15 minutes, hour, day, year. So we'll look at some examples later, but just know that it's a candle is a specific unit of time, and you can change on a chart. You can change the type of candles that you're looking at, whether it be a 1 minute candle or a 5 minute candle and so on. And I'll show you a demonstration here in a couple of minutes. Standard candlesticks consist of a candle body, an upper and lower candle wick. I will show you what I mean here in a second. A candle body will show you the opening and closing price of the period. I'll show you this in detail in a second. The tip of the upper candle wick shows the highest price during the period. Contrary to this, the lower candle wick shows the lowest price during this specific period. So this is a bullish candlestick. You'll see that it's green. And the high, you can see the very high up there. That is the upper shadow. It's also called a candle wick. If you look at the bottom, there's also a low, and that's called the lower shadow. Now, this is a bullish candlestick, which means it opens. If you look at the real body, the dark green part, it opened and it closed higher than the open, and that makes it a bullish candlestick. And then a decreasing or a bearish candlestick is the opposite. So again, you still have that upper shadow, that lower shadow, those wicks, and then you have the open, and it closes at a lower price than it opens, and you can see the real body is red. So let me show you what I mean here. I'm gonna actually go through it and demonstrate what I'm talking about and draw it for you on my screen. Okay, guys, I wanna do a quick demonstration here. I think this visual will be really helpful. So we went through these candlesticks. I showed you a bullish and a bearish candlestick. Let me draw this and just explain to you kind of in detail what's going on. I'm not an artist, so do not laugh at my drawing. So this is a bullish candlestick because it's green. Okay, you've got your candle wick right here. It's called the upper shadow. You've also got your wick on the bottom. It's called the lower shadow. Now, since this is a bullish candle and it's green, this is your real body. It means that it opened down here, right? This is the open in your body, and this is the close right here, okay? Because it's bullish, so that means it closed higher than it opened, okay? So a candle, again, it can be any duration of time. This could be a 1 minute candle, a 5 minute candle, a daily candle. It could be a yearly candle. There's lots of different ways to look at it. Let's just pretend this is a 5 minute candle. So within that 5 minutes, this candle opened at this price right here in the body. It closed at this price up here. And at one point within that, say, 5 minute candle duration, the price was as high as up here and the price was as low as down here. But it had to open here, it had to close there. So let's do the same thing and do a bearish candle. Now this is going to be a red candle for looking at, standard Japanese candles. And again, don't laugh at my drawing because I am not an artist, but I'm doing my best here to help you with the visuals. Hopefully this does make sense and help a little bit more. So because this is a bearish candlestick, that means that we actually opened up here, right? And that means that we closed down here. So we closed we closed lower than what we opened. And this is the real body. And this is the top upper shadow. This is the lower shadow. That means that we opened up here, we closed lower down here. And at one point in that duration, in that candle, let's again say it's a 5 minute candle. Within that 5 minutes, we opened here, we closed here. But at one point, the price was as high as here and the price was as low as here. So that's the difference on the bullish and the bearish candle. And hopefully this illustration helps add some clarity. Okay, so I just showed you candles. I drew, you saw my really terrible artistic ability. You can see that my shirt actually has candles on it as well. But what we're going to do now is we're going to go into a demo and I'm going to show you chart candles and durations. I'm going to use Fidelity Active Trader Pro. You can obviously use TradingView as well. The reason I'm going to use Fidelity Active Trader Pro is because I have used it for a long time, many years, and I'm most comfortable with it. And that is where if I'm doing shorter term trades, I use Fidelity Active Trader Pro. Now you're going to get familiar or comfortable with whatever tool you use. If I've been using something for many years, it's hard for me just to change that. So when we do other chart analysis, I use TradingView because anybody can get a TradingView account. And it's really simple when we're doing trend lines and MACDs and RSIs and things like that. When I'm in a shorter, like say a 2-day chart and I'm using 5 minute candles, I'm just really used to using Fidelity Active Trader Pro. So that's what I'm going to demonstrate to you today. Okay, so on your screen, you see the QQQ and you see a chart. Now, what I want to show you, there's a couple things I want to show you. The first thing I want to show you is that the candles. So let's go for a one year chart. Now these candles are called daily, and this is probably hard to read, but if you look down here, you can see there's a today, which is the same as daily. There's a 2-day, there's a 5-day, there's a 10-day, a 1 month, 3 month, 6 month, year to date, 1 year, 2 year, 5 year, 10 year, and max. So I'm on a 1 year chart and I'm daily candles. So what that means is every one of the candles that you see on your screen, every one of these candles represents one trading day. Okay. Now you can change that. You can change it to, say you want to look at, a monthly, and depending on the duration, it might not let you, and it might not make a lot of sense like that there. So I might want to go to like a 2-day, and I might want to go to a 2-day. I like using 2-day charts with 5 minute candles. You can also use 1 minute candles or whatever you like. So this here on your screen now, this is going to be, and I know my camera is covering part of this, but you get the idea over here. You can see this is a 2-day chart, and this is 5 minute candles. Each one of these candles on the screen represents 5 minutes of duration. So again, a candle is really just a specific duration in time, and you can change what you want to look at, the data you want to look at, by changing this information down here, whether, 2-day, 5-day, 5 minute, 10 minute, 15 minute, all those different things. This is 5 minutes. I can come in here, I can change this to 15 minutes. And now you've got a 2-day chart, and each one of these candles represents 15 minutes of time. And of course, depending on what you change it to, you have different information. So that can be really confusing. And that's why, you really have to figure out what works for you. And you're going to probably use the same chart patterns over and over once you find a rhythm of something that works for you. The other thing I wanted to show you guys really quick while I'm in here is you can go into the settings right here. And so this is a standard candlestick that you're looking at right now. So each one of these is just a standard candlestick. Now watch what happens if I change this to hollow. Now this is going to be a hollow. You can see that they're all hollow, a little bit harder in my opinion to read. Some people like it. And you could also do a candlestick filled, which again, I don't prefer this. I would rather use a standard. You can also do a line, which to me, this is not very helpful at all. but some people like it. You can go to a mountain. So this is a mountain, and it shows you the mountain kind of range, and that can be useful sometimes just to get a flow. This one, this OHLC, I'm going to give you a demonstration later on that shows a chart with OHLC. I think it's very hard to see the patterns when I use OHLC. I don't like it. Some people use this. You can also use what they call a point and figure. That's a PNF. And that looks like this here, which is not even going to show up. I need to go to a max chart. I'd have to change the duration on that. It's going to show you something over here. Let me just show you really quick what I'm talking about. So if I go to a 1 year chart on here, and I go back into settings up here, the top left, and I change this to point and figure. I'm hoping this works. You see that over there? I honestly have never used that. It's just something that you can do in Fidelity ActiveTrader Pro. It's not something I've ever used. You can also change this so you can change the colors, which I think can be really confusing. So like right now, a bullish candle is green. I can change it to blue, or I can change it to a different shade of red, which is really confusing. You know, I can change it to white. I can change this however I want. You know, I suppose if you're colorblind or something, there's reasons why you might do it too. The standard is the Christmas green and red. And I use, you know, just a standard candlestick, and I use the standard colors, green and red. You can also change this from linear. There's lots of different options that you can use. I use the standard, which is going to be candlestick standard, linear, colors, green and red. Okay, next we're going to get into some patterns. There's going to be three primary ones. There's a single, a double, and a triple. Pretty self-explanatory. A single candle pattern is just going to be one candlestick. You'll see it called a single stick pattern or a single candlestick pattern or a single candle pattern, all the same thing. It's just one candle. Okay, so some of the more popular ones, the hammer family. This is a really important bunch here. This includes the hammer, the inverted hammer, the hanging man, and the shooting star. So let me show you what I'm talking about. So on your left-hand side, bottom left, you see hammer. This is really important. You see the red arrow that goes down and then the green arrow that goes up. That's basically showing you that the market was selling off, or it was bearish and it was going down. And you see that hammer. So if you look at that hammer, you've got that long wick at the bottom, that lower shadow. The upper shadow is a little bit lower. So what that's saying, if you remember what we did earlier, we talked about the body, how if it's green, that means it opened, and basically it closed higher than the open. So if you look at this, it's really interesting. A hammer, it would have opened at the bottom of that body part, and you know, on the body, right? It would open at the very bottom of that. It would have actually had selling pressure to make that long wick on the bottom there, that lower shadow. And then basically buyers came in and actually overshot and then closed higher. So within that duration, say it's a 5-minute candle, you can see that the buyers kind of took over. So if you've got a bunch of bearish candles, red candles going down, 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 and then I'll see a hammer, that can show you a turnaround and actually go bullish the other direction. Now, the reason that's important, look at the hanging man. It's the exact same candlestick, but the difference is you've got buying, you've got a bullish sentiment with the candles going upwards. Then you see the hammer, and it actually is showing you a change in direction, but to the bearish side. So now it's actually going down. Inverted hammer and shooting star, same kind of scenario. So inverted hammer, you've got the market's going down. It's bearish. You've got red. And then you see this inverted hammer, and it could show a turnaround, basically, that we're going to start to see some buying. And the shooting star, again, is the opposite, where you've got buyers coming in. All of a sudden, you see the shooting star, and now it goes the other direction. So this is a really powerful family to learn. Next is doji. So doji is interesting. What this is really showing you is there's really conflict between bulls and bears, and there's a lot of indecision. Because if you look at this, there's not really a candle body. It's just basically a wick up and down, and it's basically closing at the same place it opened, right? So if you look at the doji star, it had, you know, a wick up. There was, in that time period, you had buyers that took it up to that higher wick, took it lower, but it basically opened and closed in the same general spot. Long-legged doji even has more kind of volatility or indecision because there's longer wicks. The 4-price doji is essentially, you know, hardly any, there's a lot of indecision there. There's really, you know, the buyers and sellers are at a stalemate because you really don't have much of a wick and it's just a flat line. The gravestone doji, now you can see the gravestone doji, basically had a long wick up, but closed at that lower part of that wick. And that can be a bearish sign. And a dragonfly doji is the opposite, where you can see it close at the top of the wick, more of bullish. But there's a lot less certainty with a candlestick like this. Where they're generally used is in combination with other candles with it. So you might have a candle before it and a candle after it. And that's where a doji can actually show a turnaround. It can actually show a transition from either, bullish to bearish or vice versa. So we'll get more into that and show some patterns and examples. But really, when you think of doji, there's just not there's not a strong bull or bear sentiment. It's just kind of a indecision is the best way to explain what a doji is for that candle. There's also the bullish Maribozu and the bearish Maribozu. So Maribozu in Japanese means dominance. And these can be extremely powerful because it really shows certainty one direction or the other. If you think of a Maribozu candle, they have a long body and there's really no shadow. So there's not those wicks. It's just kind of like a long, bullish or a bearish. So if you look at a bullish one, what that means is it opened at the bottom of that candle. Look at bullish candle. Look at the very bottom. It opened down there and it closed way on the high part. Bearish, it opened up here and closed way down there. So a green Maribozu candle is formed. The stock opened at a certain level and kept rising without going down. It was just very bullish. There's a lot of certainty for the bulls, overpowering the bears. With a red one, it's formed when the price opens at a certain point and keeps falling the entire duration of that candle. And this can be a trend reversal. It can also be a trend continuation candle. And the higher the volume, the more powerful these candles can be. Okay, next you have spinning tops and spinning bottoms. Now, essentially, you can see on the bottom right of your screen, it looks like a top. You think of a top that you spin. It's got the long, top and the bottom end, and you kind of spin. It has the middle part. It looks like a top. So with a bullish spinning top, it opens and then it has a small body. It's just not a very big body, but it has a lot of uncertainty basically on those wicks, way higher and way lower. Bearish again, it basically closes lower than it opens at. But these can actually be a sign of reversals as well. The next one is a double candle pattern, of course, involving two candlesticks. Some of the more popular ones, you got bullish engulfing, bearish engulfing. So if you think of a bearish engulfing, look at your bottom left-hand side. You've got buyers, so you got the green arrow, it's bullish. You've got a small green candle, and then that big red candle next to it is an engulfing. That's a bearish engulfing candle where it just takes over that bullish candle before it. And it basically signifies a downturn. And then oftentimes you see a reversal. It goes lower, goes red. And a bullish engulfing, you've got, selling. So red coming down. You've got that small red bearish candle, and then the bullish engulfing just takes over that smaller red candle and it goes higher, and it can be reversal to the upside. You also have the bullish harami and the bearish harami. So if you look at a bullish harami, it's kind of the inverse, the opposite of the bullish engulfing and the bearish engulfing, where you've got on the bullish harami, you've got a large bearish candle, and then you've got the bullish harami is basically that green bullish candle next to it. The bearish, it goes from the green to the red. So to give you an example, this diagram here on the bottom left should help a lot. So in a downtrend, so if you look at the downtrend, you've got, so this is the bullish harami, this first example on the bottom left. So you're in a downtrend, that's number one. So you see how there's selling on number one, the far left, and the stock or the equity is going down, the chart's going lower. You then have a bearish candle, that's number two. That's kind of a longer bearish candle. And then you have a gap up, which is number three. And then four, you've got that small bullish candle. And then you got the reversal. Now, if you look at the bearish harami, you've got number one, which is, buying. There's buyers overtaking the sellers. So you've got green, and the stock is the chart's going up. And then number two, you've got the bullish candle. Number three, you've got the gap down. You've got that smaller bearish candle, and then that turnaround and reversal. And now we go from, buying to selling, and the chart goes lower from there. There's also the tweezer top and the tweezer bottom. Now you can kind of see what this is explaining here. The tweezer top formation is viewed as a bearish reversal pattern seen at the top of uptrends. The tweezer bottom formation is viewed as a bullish reversal pattern seen at the bottom of downtrends. And you can see how it's got those long wicks and kind of looks like a tweezers, right? Here's some examples here. So tweezer tops, so look at the tweezer tops. You've got a bullish candle and then a bearish candle, and they've got those longer wicks. And it basically goes from bullish to bearish, and then it sells off, Same on the right-hand side. You can see the bullish candles first, then the bearish candle, and then the price goes down. On the tweezer bottoms, it's the opposite. You've got the red candle first, then the green candle, and it basically has a reversal the other direction, going from bearish to bullish. And then on the far right, same thing, tweezer bottom, it's got that reversal from red to green. So that's how those work. Triple candle patterns. These are very powerful, involves 3 candlesticks. So can you guess? Yeah. So can you guess? It's 3 candlesticks. Pretty self-explanatory. Here are some popular ones. So the morning star, you've got the evening star, you've got the 3 white soldiers, and you've got the 3 black crows. So these are basically, one's bullish and one's bearish. For each of these, there's 4 examples. So the morning star is essentially a reversal, from bearish to bullish reversal pattern. And then you've got the evening star, which essentially you've got the market in an uptrend, or you got the asset or the chart in an uptrend, and it's a reversal to the downside in the evening star. 3 white soldiers, it's often used for daily candles. If you get 3 days in a row where you've got 3 green candles like this, it's showing very bullish activity. The opposite of that is going to be the 3 black crows, where it's very bearish. You got 3 red candles like that back to back. So let's look at upside reversal candlestick patterns. Now, if you look really close at your screen, look at the far left, you see where it says hammer. You see how there's red candles before it, and then there's the hammer, and then green on the other side. Every one of these is going to have, on the left-hand side, is going to be red. So you've got, bearish activity, you've got sellers, and then all of these candlesticks are going to be reversal candlesticks that are going to take it from red to green. So the hammer, you've got selling. Again, if you remember, if there's not red candles on the left-hand side and they're green candles, then it's probably the opposite, like we showed earlier. You got the morning star, you got the bullish morning star, the morning doji star, bullish dragonfly doji. And I'm going to show you a side-by-side comparison, because every one of these has an opposite, basically a friend and foe. So one's bullish and one's bearish. You got the tweezers bottom, the bullish belt hold, the 3 white soldiers, the piercing line, bullish engulfing, bullish harami. We could spend a ton of time going through and explaining what all of these are. I'm going to kind of show you later on the ones that I think I use the most, that are easiest to spot. Here's the downside reversal. So the exact same thing we just saw, just the bearish side of it, right? So now you're going to see green on the left-hand side. You're going to see green candles, and then this is going to be a candlestick reversal that's going to take it from green to red. The shooting star, the evening doji star, the bearish gravestone doji, the bearish long-legged doji, the tweezer tops, the bearish belt hold, the 3 black crows. Again, you got the 3 white soldiers, the 3 black crows, one's bullish, one's bearish, dark cloud cover, bearish engulfing. You've got, of course, bullish engulfing is the opposite, bearish counter attack line, and then the bearish harami. So I know that's a lot, but these are really good examples, and it's just kind of to get your feet wet a little bit with these. Okay, so this is what we just covered, and I put them side by side because I think it's a good visual. So on the left-hand side, you've got the upside reversal candlestick pattern, where you had basically selling pressure, and then you had, basically reversal to the upside. So you've got, red candles on the left-hand side, and then green on the right-hand side. And then, of course, the downside reversal, the chart's going up, and then you've got the reversal candlestick pattern, and it's going the other direction. But if you look at, for example, the hammer and the hanging man, they look very similar, except one's coming from selling pressure and reversing to the bullish side, and then on the hanging man, it's doing the opposite. It can be actually really useful, I think, to look at these side by side. These are all opposite of each other. So the morning star, and then you got the shooting star, the bullish morning star, the evening star, the morning doji star, the evening doji star, right? So they're just counterparts. One's bullish, one's bearish. You got the bullish dragonfly doji, and this is where dojis I mentioned earlier, they show uncertainty within the that time frame or that candlestick. It's basically showing uncertainty. There's kind of a tug of war between buyers and sellers. It's not a very defined candle. But if you see a bunch of red candles before you see a bullish dragonfly doji like that, it can be a sign of a reversal. So dojis can be powerful when used with other candles within a chart pattern to find reversals one way or the other, right? So you've got the bullish long-legged doji, but then there's the bearish long-legged doji. You got the tweezers bottom and the tweezers top, so there's an opposite to all these. The bullish belt hold, the bearish belt hold. You see the difference though? One's coming from selling pressure and going to buying, and one's coming from buying to selling. So it's pretty self-explanatory, but I think it helps a lot to see the visual side by side. The three white soldiers, bullish. Three black crows, bearish. You've got the piercing line and the dark cloud cover. You got the bullish engulfing versus the bearish engulfing. What's the difference? Well, you can see on the chart, right? The bullish engulfing, red candles, small bearish candle to a larger bullish engulfing candle, and then that's a reversal to the upside. The bearish engulfing, you got buyers, 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 small green bullish candle completely engulfed by the next candle, which is a large red candle taking you to the downside. You've got the bullish counterattack line, the bearish counterattack line, the bullish harami that we mentioned earlier, and the bearish harami, which is cut off, but you can kind of see the bottom there. So those are side by side. I thought that was really helpful to put that visual together. So here are just some examples of where I might buy or sell. If I see, and these are the ones I more commonly use because honestly, I'm going to be completely transparent. I always am. Nobody's an expert at every single candlestick or every single pattern. You really have to find what you're good at and just practice. And once you find something that works for you, you just stick with it. For me, it's really going to be bull flags and pennants and things like that. Those are the easiest, the simplest. I have the highest win rates on those. But if I see, for example, a bullish engulfing, that's usually a pretty strong signal that you're going to see more buying after that candle. Bearish engulfing, the same thing. If I'm in a trade and I see a bearish engulfing candle, I'm going to get the heck out of that trade and sell. The hammers can be powerful as well. There are some fake outs sometimes on that, but if you can see a couple examples where it could be a buy. The top right there, the morning doji star, that can be a buy signal. That's powerful. The dark cloud cover, generally sell. Shooting star, sell. The hanging man, sell. The rising sun, buy. Those are just some examples. I'm trying to give you as many illustrations as I can. The cool part about this is if you see a candlestick or a pattern or what have you on this video, you can always go dig on your own and learn more about it if you think it's something that you would be able to find easily on a chart and be able to use to your advantage. Now I put this slide together really just to show you some continuation patterns, but really I wanted to show you just how many different types of patterns, candlesticks, charts, combinations that you really can get yourself into. And I want to reiterate the fact that if you're a long-term investor, you don't necessarily need to know all this stuff. I know some of you are probably really interested in maybe learning how to do this so you can do more active trading and things like that. But I really want to put this together for you just to show you how deep in the weeds that you really can get with some of these patterns. Some of these, I generally don't use myself, but others might. You can dedicate your whole life to learning technical analysis. You can make a great living doing that if that's what you want to do. But if you did that, you would get much more into these patterns and get much deeper into reading these charts and candles. So this is just kind of an illustration to show you a bunch of different types that are out there. Okay, so next, what we're going to do next, we've taken all the candles, we learned about candlesticks. Now you have to be able to take those candlesticks and apply the candlesticks within patterns. Essentially, these are all going to be tools in the tool belt, but you have to use a combination. So you're going to be using the candlesticks, you're going to use the chart patterns, you're going to use RSI, you're going to use MACD, you're going to use the moving averages, you're going to use trend lines, all these different things together to make one informed decision. Because one thing by itself is never a guarantee, and I'm going to show you what I mean here in a second, because you can have a stock chart pattern that looks very bullish, but a couple of candles could actually show you whether it actually is going to be bullish or bearish next. But let's look at some examples. So on the top, you've got reversal. So you've got the double top, you got the head and shoulders, you got the rising wedge, you got the double bottom, inverse head and shoulders, the falling wedge. And I'm going to go through some of these in more detail with nicer charts here in a minute. You've got continuation chart patterns. You got like a falling wedge, a bullish rectangle, a bullish pennant, a rising wedge, a bearish rectangle, a bearish pennant. Okay. And these pennants can be really powerful. The bull flags, the bear flags, they can be very powerful. The wedges can be powerful too, but you have to understand the candlesticks within these patterns as well, because you can get burned if you don't. And then there's the bilateral. So you've got ascending triangles, descending triangles, and symmetrical triangles. Let me show what I mean here in a second. Now this slide here talks about bilateral patterns, and you can look at it. Look at the left-hand side for me for a second. Ascending triangle on the top left, right? On the bottom left, also an ascending triangle. Now stay with me, because I'm going to do something after this that's going to be more illustrative. I'm going to use my fun new tool, and I'm going to draw on this for you and make sense of it for you a little bit better. But look at that left-hand side, ascending triangle, the top and the bottom. They look almost exactly the same. They look exactly the same. But one breaks to the upside and one breaks to the downside. Now, why is that? Well, if you look really closely, there are some candles in there that are a little bit different on each. And one makes it break up to the upside and one breaks down to the downside. So just understanding a pattern, you might look at this and say, Eric, every time I've seen a triangle type pattern, it always breaks to the upside. It generally coils and breaks to the upside. How is it possible to break to the downside? It can break to the downside. And this is where you have to look closely at the candles especially when you come to the end of that triangle. If it starts to break down, it's going to go to the downside versus, the upside if the candles look bullish. So I'll break that down for you in a second, and it'll make a lot of sense. But the thing to notice on the ascending triangle, if you look, you've got that resistance line. That's just a straight flat line on the top. And then you've got that bottom line that's basically ascending triangle that's going upwards, right? So it's a little bit different than, say, the symmetrical triangle on the right of your screen. That one, you can see the top is not a complete flat line on the very top. But look at the middle of your screen right now. You got the descending triangle. Same kind of thing. The charts look almost identical. One breaks to the downside, one to the upside. And it has to do with a couple of candles that basically are going to take it bullish or bearish. Same with the symmetrical triangle. One thing to point out with the symmetrical triangle is it looks a lot like a pennant or even a bull flag, where you kind of have that consolidation. You've got the flagpole, and then you got the pennant, or in this case, it's a triangle. Those a lot of times are confused, and they look very similar. Honestly, though, if you understand this symmetrical triangle, if you understand a bull flag and you understand the pennants, they're all very similar, and they more often than not break to the upside. But as you can see in the bottom right hand of your screen, they can break to the downside. And this is where we have to pay attention, and really close attention to those candles as we come to the end of those triangles. Okay, guys, I got my fun tool back out. I think this will be helpful. I wanted to go through this. We just looked at the slide that had this exact same picture on it. I want to go through this and break it down and just give you some arrows and illustrations, because I think it'll be helpful. So if you look at this left-hand side, you've got ascending triangle, and they're really, if you look at them really close, these candles are all pretty much the same, right? They look identical into a certain spot. And so you see your first difference is right here. You'll start to see a difference, right? You see the difference between there and there. Everything before these candles are actually the same. These candles are all the same. So both of them are in an uptrend. They've got the exact same ascending triangle pattern. Most of the time in a bull type market, you see this consolidation, and it'll break up higher, especially on longer charts. Shorter term charts, definitely harder to say. But this is where you can get in trouble, because you can draw this on TradingView, and you can draw this up and say, yeah, it's in an ascending triangle and it's going to go higher. It doesn't always have to go higher. And this is where the candles themselves become important within the overall pattern. You have to use them together, because what happens is, if you look at these candles again, are the same, but then you start seeing differences right here and right here. And what ends up happening is you've got a bullish situation on the top one. You see it's bullish here, and then it breaks out. This is a huge bullish engulfing type candle. And that's, once it breaks the top of this resistance line in this triangle channel, it's going to go higher. And usually you're going to target some kind of a Fibonacci above here, but this is definitely a breakout, and it's going to go higher for a little while at least, right? Now, if you look at this bottom one, the opposite happens and the candles start to show bearish activity, especially right there. And then it has this kind of bearish engulfing and it breaks out of that triangle channel. And once it breaks out of that channel, it oftentimes can go quite a bit lower. And a lot of times it'll come down to the beginning of this uptrend. It'll erase, 2/3 of the gain and do a Fibonacci back the other way, right? So that's something to look at on these ascending triangles. If you look at descending triangles, it can be the exact same thing. If you look in the middle here, you've got the same overall pattern, but this one breaks up to the upside, this one breaks to the downside, and it's just a couple, candles that have a small difference that make the difference between this thing breaking up or down. And in this right-hand side symmetrical triangle, same thing. The big one here is you got this big bullish breakout right there. This is generally, once it breaks out of here, you buy in this range. It's generally pretty safe and it goes a little higher. But sometimes it actually will break out of the triangle. It'll go a little bit higher. And sometimes you don't have this big, nice bullish candle and it can break down. And it doesn't always mean just because you've got this big bullish candle, it's going to go higher. But the chances are, if you see a big, huge bullish candle like this, the chances are it's probably going to go a little bit higher before it breaks down. Same situation here, only on the bearish side. You can see this is a huge bearish candle that breaks out of that triangle to the downside. So I thought this would help, just breaking it down with some arrows. Let's go on to the next section. Now this is a bunch of continuation patterns I put together. You got the falling wedge, you got the bullish rectangle, you got the bullish pennant. Bullish pennant, we just kind of talked about that, very similar to a couple other patterns you'll see. A lot of times it breaks to the upside. The thing with the bullish pennant is you have to have a nice, like with a bull flag, you want to have that nice flagpole, and then that pennant. There's also the opposite, which is a bearish pennant. There's a bearish, flag, a bull flag and a bear flag. So on the bottom right, you see the bearish pennant. There's also a bear flag. And then on the left-hand side, bottom left, you got your rising wedge, you got your bearish rectangle. So wedges should be pretty self-explanatory. One is going downward. If it's a falling wedge, it's consolidating downwards. A lot of times it pops the upside. And if you look at it really closely, look at where we came from. The market is green. So it's coming in, the stock is actually, the price is going up. And then it starts to consolidate and creates a falling wedge downward. It consolidates and breaks to the upside. Very similar to a bullish pennant, where it's coming into a bullish rally. It breaks down, consolidates before it goes higher. Now a rising wedge, if you look, the stock's actually going down. You see a bunch of red candles. So look at the bottom left of your screen, the rising wedge. So the stock's going down. You see red candles, red candles, red candles. Then it finally starts to hit a floor, and you can see it's consolidating up, which looks really healthy. The problem is a lot of times that breaks down out of that channel, out of that wedge, and it goes lower. The middle, you got rectangles. Rectangles is just when it kind of pops up. Amazon would be a good example. If you look at an Amazon chart, pops up. It's trading kind of in this channel, in this range that can create a rectangle. With Amazon, it's beyond a rectangle because it's so long now, but that's kind of the idea behind it. The bearish rectangle in the middle, the bottom middle of your screen, that's where it breaks to the downside. And it really comes to do with, if you look at, it starts to break down and it breaks that support line and goes lower, where on the bullish rectangle, it breaks that resistance line and it goes higher. And that's really important to understand. Those bearish pennants can be really nasty, and those bear flags, because it can drive the stock a lot lower. On the opposite side of that, I really like trading on bull flags and bull pennants, bullish pennants, because you can get really nice pops to the upside. They're very powerful, especially if you have a really strong flag pole that kind of brings you into that consolidation range. Now these are reversal patterns. You'll see double tops, you'll see head and shoulders, rising wedge. Those are all bad because they are taking the stock lower. The ones that we like as bulls are double bottoms, where we're going to double bottom and then break to a higher range. Inverse head and shoulders, where you've got essentially, head and shoulders just flipped upside down, and it's going to be bullish when it breaks out, and then the falling wedge. And all those are pretty self-explanatory. If you think of a head and shoulders, you essentially have a higher peak at the top in the middle that's kind of creating that head, and then two peaks, one on each side of the head, that's creating the shoulders. And it doesn't have to be as symmetrical as it shows you here. A lot of times the shoulders are a little crooked or something, but Those are some examples of reversal patterns. Now, this is not your standard Japanese candlestick, and I don't like using these at all. And I just wanted to show you how much harder, in my opinion, it is to try to read this chart versus one that has the colors on there with the red and green. But you can see that, there's a triple bottom, but, good luck identifying that, for me personally, if I don't have my Japanese, my red and green, my Christmas candles, right? You got your head and shoulders in the middle, and you've got your pennant. And that pennant, again, that could easily look like a bullish pennant, but it breaks down to the downside out of that pennant channel, and it goes much lower in that case. Now, if you look at this chart here, so it's the same chart twice. So look at the very bottom of your screen. That's just the chart without any analysis on it. The top has some analysis that breaks down some different patterns within a longer trend. So this is a yearly chart, and it's breaking down. You had a double top at the beginning of the year, and then you had a double bottom going into a head and shoulders, into an inverse head and shoulders, into a rising wedge, to a falling wedge, and so on. It's kind of like statistics. You can look at something and look at it a certain way, and someone else might see it a little differently, or they might use the data a little differently. So keep this in mind. These are all just tools in a toolbox. The more knowledge and information you have, I think the more powerful you can be as an individual investor. But by no means are you going to, watch this video, look at some of these charts and be an expert on tomorrow. It's going to be an ongoing process, ongoing learning process. I'm still learning all the time when it comes to technical analysis, and I've been doing it for a while, but I'm still learning all the time. And it's very interesting to me. It may not be interesting to you, but you can see where these general patterns and candlesticks can really be powerful if you just understand them, even in the simplistic form. All right, guys. So that was Technical Analysis Volume 2. I know it's probably a lot of information, but I tried to really make it as simple as I could. I think that if you are new, this is probably really exciting stuff. If you've been trading for a while, some of it might have been review, but hopefully you learned a few things as well. I put a lot of time trying to make this visual and interactive, so hopefully it was appreciated. But this is a fun topic. Like I said earlier, you can spend your entire life, studying charts and trying to be a chart master. And if you put, 10 chart masters on one chart and say, give me some analysis, you'll probably have slightly different answers from all those chartists. It's kind of one of those things that can be very subjective, and people see charts differently sometimes. So nothing's ever a slam dunk by itself. It's just kind of increasing your odds with patterns, just like in nature, patterns reoccur. And this is how technical analysis can be used to be a better long-term investor for entry and exit points, but it can also be used to be a trader if you want to do a little swing trading or day trading to supplement. Some people enjoy doing that. That is it for the day. That is masterclass number 10. We will be coming with masterclass 11 here in the next few weeks. There's going to be a total of at least 12 masterclass videos, maybe more after that. So please do stay tuned. I'm excited to keep making these for you guys. I appreciate your time and attention. I hope you have a great rest of your day. Take care.